Hello, welcome, Truth Seekers. I am Gordon. As promised, here's my trade recap on last trade I took on gold that afforded me over 5 RR. As you can see the execution here on the right corner of my screen. In this video, you will get my perfect source, that is my personal checklist. And in addition to that, you also get the confluences I look out for before I take any position or execute any trade. In my last video, I did a breakdown analysis, or more like a recap of how I got over 8 RR, taking a sell position here. You can check the video in my channel, just the first one I uploaded. I think at that point, I had missed this sell here. Then I got in around this point, got out here. So it was over 8 RR. All right, let's get right into it. As you know, I'm a candle trader, right? Credit to Romeo, that's Raid. I'm a candle trader, and what that means that that's CRT, right? Candle range theory, or you say candle range turtle soup, or candle range time. What that means is that I look out for just a specific candle that I want to trade. It could be a weekly candle, a daily candle, a monthly candle, a 4-hour candle. In case of gold, it can be 50 minutes candle range. It can even be 5. It depends. All right. But I just advise maybe just stay on maybe 15 minutes as a higher time frame and the likes. So this is what happened. On this particular day, 30th December, coming to the market, this particular candle here had been formed. Then already, because based on what we've been getting so far, we have more like a very huge displacement all the way from the all-time high down to that particular point here. So chances are price could be traced. If you go to the higher time frame, this is what you see, right? A huge displacement. Apparently, price will try to, offer fair value in a way, going back to more like we balance this inefficiency here in the price action before rolling over, maybe going down more. Or sometimes it might be a path to engineering liquidity or generating liquidity, which is more like the second thing that price do. So of the four things that price do, that's more like the second, engineering liquidity. So price will usually attack highs, that is, hunt liquidity, sweep liquidity, read liquidity, turtle soup, liquidity pool, and then sometimes it will just generate liquidity, hunt that liquidity to seek imbalance or inefficiency, and sometimes it will just offer fair value. There are about 14. So all of those things I explained in the previous video, so you can check it out later. Now, what happened? I saw this, and then apparently I'd gotten more like my 4 hours range that I kind of like to trade. So all I have to just do next is to more like go through my perfect source, my list of things that I check out before executing a trade. And here we have it. Voila. So each time price hits a key level, which can be for me fair value gap, basically their institutional reference point, FVG, rejection block, name it, order block, hold highs and hold lows. At this particular point in time, when market open, at the point I got to the market to want to trade on that particular day, 30th Tuesday, this candle had already been formed, and as well as the second one here, this second candle in this more like supposedly 3 candle model CRT into this key level here. This is a fair value gap or sell side imbalance, buy side inefficiency, CB. This second candle had already formed more like the manipulation candle from the 3 candle model, candle 1, candle 2, candle 3, candle 2, closing within the range of the first candle, and the candle 3 distributing or expanding. Remember that higher time frame key level always produces lower time frame expansion or lower time frame distribution. So I tried. I actually executed this one. You can see that in the video in the shot that we have at the right corner here as more like the first trade I executed on a particular day. And here's it. So that candle had been formed just before I got to the market, and then it was more like here already have more model one, that is that specific candle that raided the previous high or the old high. In this case, this is our CRT high here, our CRT high, and then this more like a high that was formed but didn't, as far as it didn't close below this candle here, that means we're still the model one has not yet been formed. Until then we have a very maybe on that huge 50 minutes candle going up, raiding or taking or souping this one all candles here, this previous high or passive highs or liquidity. And then by the time we start having closes below this candle here, that means that model one is ready. All right, but you will notice that the low that formed the particular high, let me zoom in quickly. So I intend to keep this video a bit under 15 minutes. So the low, this is a high, this is a low, and this is another high. Before we can begin to say we have a shift in a shift in market structure or say change the state of delivery, there must be close below this particular low here. Okay, below this particular low, it must be closes below this particular low. And then what do we have? It came into this more like rejection block, not more, it's a rejection block, and then went back to take this high. So we have more like a higher low, a higher high, more like see trending up, and then what happened next? A shift in market structure. It shifted. We have a change in the state of delivery from here. All right, and then we have a change in state of delivery here, which means that as at this point here, our model one is ready, and it already signals a sell, and that's exactly why I executed. But now coming to it now, it's more for me it was more like a FOMO. I didn't really pay much attention, and that's exactly why I lost, because one of the things I look out for, as you can see on this checklist, where are you? There you go. And I'm just going to pause. Okay, tell you how. As you can see on this checklist, we have a price hits a higher time frame key level, and then we have a raid or a swoop or internet region liquidity has been taken. The third is that it must form an SMT divergence, right? But it's not like sort of compulsory, but it's one of the things that I look out for. Around this point, there was not really a divergence, so to say. If we were to show you quickly, silver trade around that time, silver chart. 1 second. All right, let me just quickly show silver. Silver around that particular time, there was no silver at this particular time. There was no SMT. The high, okay, there was no SMT. I thought it's a high. There was no SMT, which means it's not really like my A plus setup, but yet I took it. So that's it. I took it, and the trade ended up in a loss. It could have been avoided if I had paid much more attention than I did. I just executed the trade and I dropped my phone without really paying much attention, which is on my own side wrong. So on a lower time frame, which is this supposedly lower time frame, it became a high time frame corresponding to that of 1 minute. We have a CRT candle here forming inside in this key level here. We have a high time frame 50 minutes key level, which is a rejection block, a 50 minutes range, the low here down to the high here. If I had paid more attention on executing this trade at around this level here, and if I had noticed this particular candle, I would have stepped down to 1 minute to really confirm that that was in a way against my bias. And I tell you, I will have just changed it right at that moment. Hand my, at least I will have closed my trade in a break even, other than losing the entire risk. All right, so that's that for now. That said, all right, so I took that loss, and then next, the following 4 hour candle, 8 o'clock candle, the open of Frankfurt section, 8 o'clock. What do we have? We got this. We got that, and this one here. I believe you can see the execution on the right corner of my screen. This is what we have at that particular point in time. So 8 o'clock 4 hours candle, my time here. This should be the usual. Let me see. Uh, um, 5159. This should be the usual 5 o'clock New York 4 hours candle. All right, 5 o'clock New York 4 hours candle. All right, you can check the corresponding what the time would be in your own time zone. Okay. All right, so that's 4 hours range. We got this a range into the key level yet. And take note of something. I didn't even see this. Okay, take note of this. Look at that. The halfway point, which is referred to as by ICT now, halfway point of that inefficiency or this gap here, the consequence equation. Now, this is one reason why I believe market is not random. The halfway point of the particular inefficiency, this drop, this displacement here, turned out to be the part or that level that we send price down. It's more like a catalyst here. It's a level. It's referred to as the consequence equation by the ICT. All right, now upon this one closing, we have a 4 hour candle range, and then this is more like the classic 159 CRT 3 candle model, right? Candle 1, candle 2, candle 3. All right, candle 1, accumulation, manipulation, distribution, right? Just like what we have here. Now, talking about confluences that I look out for, this here is number 1. You can put that down. The consequential encroachment of this CB, sell side imbalance, buy side inefficiency, right? That's one. We have a candle range. The key time the time also matters. Dropping down to the lower time frame, corresponding to H4, is what we have. You can see the body closing below that particular candle and the high and the wicks doing the damage. This is what we have. Okay, this is the high, the candle range high, CRT high plus turtle soup. This is our CRT low, CRT low plus target. Okay, now where is our model 1? This is our model 1 here at the close of this candle here, the open of that candle that broke the previous high. That's our model 1. Model 1. I believe you can yet see the execution on the left right corner of my screen, and then we have an execution. I think my execution was around here. I think I executed around there. At first, this is my initial target. That was my initial target. I put my stop loss just above this huge candle. That just immediately above this huge candle that caused just above the open of that huge candle that broke this level here, this low here. All right. So what happens next is that I just only waited. So I'm gonna pause so we can see how it played out there. Great. Now, speaking of the confluences now, this halfway point, 50% of this gap, turns out is the first confluence. The second, we have a range, right? We have a range into a key level, and the timing was perfect. The time of the manipulation was perfect. It was around, this is 14, just the open of New York, the open of New York, right? The timing, that's confluence number 2. And the third confluence, which is more like the third on the list of my perfect source, which is that it must form an SFT divergence, and the fourth, which is must give us a change in the state of delivery, which I showed the model 1, and at the key time, and then all I have to do is just target 3 risk reward ratio, 3 RR or more than that. So let's see this. Now, what do you notice? This high, right, and this high, this is a higher high, and on gold, what we have is a lower high. There's a high here, and this a lower high on gold, turning into SMT. So now, what do we have? This is like exactly what I said, a perfect source. Okay, price tap into a key level beautifully. Consequential encroachment of this displacement candle here, of this gap. We have a 4 hours range into a key level. It forms an SMT, smart money techniques divergence. So that's SMT divergence. Now this is a signal that shows that this price market makers are no longer interested in taking the price beyond this particular high or even close to this particular level here, because on the silver that had been taken, on gold it had not been taken. So on gold, in a while, maybe it won't be going there. This is more like, I won't call it a guarantee. We could say that's a signal just telling us that price will not be going there anywhere from that time, maybe until later in the future. Okay, so this is more like the third confluence I got, aside from the 50% encroachment, the timing, which is the open of New York, the key level, which is the inefficiency, and then change the state of delivery, which we got on this lower time frame. We have a change in state of delivery. So what happened is that even after getting into this particular market here, it did all of this and it took time. So I had to be patient and be disciplined in the management of the trade, because it's not about just really knowing where the price is going to next. There is this skill that you must have to, which is the one that requires you to be able to manage your trade effectively and optimally. So at this point, in a way, I wanted to take out half of the position size, and then, but I was carried away until the next time I realized price was already here. So all I had to do was just lock in, move my stop loss, as you can see in my in the shorts just at this corner here. I just locked in, move my stop loss to break even, and then watch price do its thing. The moment it got here, I closed half of the position, as you can see there, and then knowing fully well that this level here is reachable. Why did I extend my target to this particular level, which offers me around 7 hours, as you can see here in this video? Why did I do that? So let me quickly explain. Right, like, about the 4 things that price seeks, all right, or 4 things that price does. Okay, let me quickly go back to 4 hours time frame. Right, price will move. Okay, when price move, what do we have from here? We have a high, more like a low, a lower high, a lower low, a lower high, a lower low to this point here, and that is more like, this is a low here. I'm just a low, a lower high rather, a higher low. This is a red. All right, this here, this particular low here, it's what some or most people refer to as the hanging fruit. Right, since there has been more like a turtle soup here, the next target, which is the extreme now, the external liquidity pool is this one here. Not just, although like I said, we are candle I'm a candle trader, right? I get in at the open, I get out at the close, right? Open, low, high, close. But then there's nothing stopping me from extending my target. When I feel like I've gotten a very good position here, I could just extend it down to this particular point here. And that's exactly what I did. All that the virtues or other values said I just needed was just patient. So I gave it time to just do its thing. I got half of the position out and I waited until it eventually got it, as you can see in that video. So the third conference and exactly why the fourth actually, and why I had to extend my target was because this low here was doable. It was reachable in a sense because this is already forming more like that hanging fruit, right? Price goes from external range liquidity to internal range liquidity back to external range liquidity if it's trending, right? Like this: a high, a low, a lower high, a lower low. It's engineer liquidity. As it is going, it comes back to rate liquidity. Turtle soup goes down more. It comes out engineer liquidity, goes low, takes out liquidity and goes down more. Something like that, right? So this is was more like that engineered liquidity, and then this. All right, let me just hold on. This low here is more like this low here, and this high is more like the high of this 4 hours range. Comes at the top to soup it, and now having gotten to the low of that 4 hours range, this low external range liquidity is doable because obviously we're in a downtrend. That's exactly why I extended down, and I had to do was just to be patient, and I actually got rewarded for that, for my patience. All right, so this for now. If you do have any question, do leave it in the comment section. And if you like this content and you want to get more like this from me, do hit the like button and hit as well the subscription button, and you can turn on the notification. So this is I'll be seeing you in my next video. Thank you.